recognize and overcome this bias. Sharing your experience can help others recognize the signs of overconfidence and help prevent them from making similar mistakes. Point out that overconfidence can lead to poor decision making, excessive risk taking, and eventually financial losses. Overconfidence and its downfall. The pitfalls of excessive risk taking in futures trading. A common trap that many futures traders fall into is overconfidence. Following a string of successful trades, a sense of invincibility can settle in. This self-assuredness, while a great morale booster, can unfortunately lead to poor decision making, reckless risk taking, and ultimately significant financial losses. Confidence is key in trading, indeed, but overconfidence? That's another story. It often springs from a series of successful trading streaks, making traders feel like they can do no wrong. Such a mindset can cloud a trader's judgment, overlooking the role of the market conditions and even luck can lead to an inflated ego. An overconfident trader might start taking larger positions, assuming that their winning streak will continue. They might start straying from their initial trading strategy, dismiss stop-loss orders, or hold on to losing positions for far too long, all in the belief that the market will eventually move in their favor, which there is no guarantee that it might. However, as many experienced traders would affirm, the market owes nothing to anyone. It doesn't care how many successful trades you've had in the past. It moves in response to a multitude of factors: economic indicators, geopolitical events, supply and demand dynamics, most of which are outside of a single trader's control. Excessive risk-taking driven by overconfidence can rapidly eat into a trader's capital and result in substantial financial losses. This is particularly true in the futures market, where the use of leverage can amplify both gains and losses. The next time you find yourself on a winning streak, remember to check your overconfidence at the door. After all, humility is a trait often found in the most successful traders. Now, we'd love to hear from you. Have you experienced a blow to your trading account due to overconfidence? How did you bounce back? Your experiences can serve as valuable experience to other traders to help them avoid some of the common pitfalls. The gambler's fallacy. In the gambler's fallacy, the mistaken belief that if something happens more frequently than normal during a certain period, it will happen less frequently in the future, or vice versa. Understanding misconceptions in probabilities in futures trading. The gambler's fallacy, also known as the Monte Carlo fallacy, is a common cognitive bias that surfaces in various facets of our lives, including futures trading. Essentially, it is the misguided belief that if a particular event occurs more frequently than normal during a certain period, it is likely to occur less frequently in the future, or the other way around. This fallacy is named after the notorious event at the Monte Carlo casino in 1913, when the roulette wheels landed on black 26 times in a row. Bettors lost millions betting against black, assuming that the long streak of black meant red was due. A perfect example of the gambler's fallacy in action. But how does this apply to futures trading? Let's say you've noticed a particular futures contract has been increasing in value more than usual over a certain period. If you fall into the gambler's fallacy, you might erroneously conclude that this trend is bound to reverse soon, and you take a short position expecting the price to fall. However, in the realm of trading and investing, past performance does not predict future results. Each trade is independent, and the outcome of one does not influence the outcome of another. Just like a coin flip, where getting heads 5 times in a row does not increase the likelihood of getting tails on the next flip. A futures contract price increasing or decreasing several times in succession does not necessarily mean a reversal is imminent. Understanding and acknowledging the gambler's fallacy can help you make more rational, informed decisions in futures trading. It is critical to rely on the comprehensive analysis and sound strategies rather than misguided beliefs about probabilities. Have you ever fallen prey to the gambler's fallacy in your trading experience? How did you correct this cognitive bias? Share your experiences because sharing this would help others learn from your past mistakes and also help you express your experience as well. Talk about how this fallacy can lead traders to make irrational decisions based on a perceived pattern that does not exist, leading to potential financial losses. The danger of misinterpreted patterns, the gambler's fallacy in futures trading. The gambler's fallacy can lead futures traders down a precarious path. As we've discussed, this common cognitive bias lures traders into believing that if a particular event occurs more frequently than normal within a certain period, it is likely to occur less frequently in the future, or vice versa. Traders, under the influence of this fallacy, might believe that they're spotting a pattern or trend where one does not exist. This can result in costly misstep. In the volatile world of futures trading, perceiving patterns that doesn't exist can have significant financial implications. For instance, a trader might see a futures contract's price rising unusually frequently over a certain period and, due to the gambler's fallacy, decide to short the contract, expecting its price to drop. Conversely, they might see a continuous decline and decide to go long, expecting a rebound. In both cases, the trader is basing their decisions on an illusionary pattern, rather than grounded analysis of the market data. Futures markets, like all financial markets, has a degree of randomness. No outcome is ever guaranteed, and each trade is independent of each other. Falling into the trap of the gambler's fallacy can lead to irrational trading decisions, excessive risk-taking, and potential financial losses. It is essential to recognize this fallacy and instead base trading decisions on comprehensive market analysis, a solid understanding of futures contracts being traded, and a well-thought-out trading strategy. Making decisions based on perceived patterns from a string of outcomes can lead you astray. Have you ever made trading decisions based on perceived patterns that turned out to be non-existent? How did it affect your trading outcome? It would be enlightening to hear your experience and how you've adapted to avoid falling into the gambler's fallacy trap. Facing the psychological challenges. Emphasize the importance of developing emotional resistance, maintaining a disciplined approach, and creating a solid trading plan. Trading tides. The imperative of emotional resilience and strategic planning in futures trading. In the dynamic arena of futures trading, where fortunes can change with a single shift in the market, emotional resistance, disciplined approach, and a robust trading plan are not just advantageous, they are indispensable. Distress, anxiety, and potent mix of fear and greed encountered in futures trading can pose formidable challenges to even seasoned traders. Emotional resilience is your bulwark against these tumultuous waves. It enables you to weather the inevitable storms, maintain composure in the face of losses, and stay grounded during winning streaks. It is about understanding that trading, much like life, involves ups and downs. It is about having the tenacity to endure the lows